When the economy takes a hit, most people panic. The headlines are filled with doom and gloom, and it's easy to feel overwhelmed by the uncertainty. People start worrying about their jobs, their savings, and what the future might hold. It's a natural reaction. After all, nobody wants to see their hard-earned money at risk. But here's the thing. The wealthy? They see downturns as opportunities. Instead of letting fear take over, they look for ways to turn the situation to their advantage. They know that every crisis brings a chance to grow their wealth, if they play their cards right. So, where do they actually put their money when things get rough? Let's break it down. First up, blue chip stocks. These are the giants of the business world. Companies that have stood the test of time and proven their resilience through countless economic cycles. These are massive, established companies with a track record of weathering storms. Think Apple, Johnson & Johnson, or Coca-Cola. They're household names for a reason. They've built trust, brand loyalty, and have the resources to adapt when times get tough. The wealthy love these because they pay consistent dividends, and their products are always in demand, no matter the economy. Even when people cut back on spending, they still buy essentials. So these companies keep making money, and so do their investors. Next, we've got ETFs, exchange-traded funds. These are like baskets of stocks or bonds, letting you invest in a whole sector or market with a single purchase. It's a simple way to get broad exposure without putting all your eggs in one basket. Instead of betting on a single stock, the affluent often spread their risk across the entire market with ETFs. This approach helps them ride out the ups and downs. Since not every company or industry is affected the same way during a downturn, something like the S&P 500 ETF lets them own a slice of America's top companies. It's a way to tap into the overall growth of the economy, even if some individual stocks are struggling. Even in a downturn, the long-term growth here is undeniable. History shows that markets recover, and those who stay invested often come out ahead. Now let's talk real estate. Property has always been a favorite for the wealthy, and for good reason. It's a tangible asset, something you can see and touch, and it often holds value even when other investments falter. Property values fluctuate, sure, but during a downturn, some of the best deals pop up. Sellers may be more motivated and prices can drop below their true worth, creating opportunities for those with cash on hand. The wealthy look for distressed properties or prime locations at a discount. They know that buying low during tough times can lead to big gains when the market rebounds. Rental properties keep bringing in monthly income, even if values dip temporarily. People always need a place to live, so rental demand tends to stay strong, providing steady cash flow. But that's not all. Bonds are still in play. Bonds are essentially loans to governments or companies, and they pay you interest in return, especially government or high-grade corporate bonds. These are considered some of the safest investments out there, especially when the stock market is unpredictable. They're not flashy, but they provide stability and predictable returns when everything else feels shaky. For many wealthy investors, bonds are the anchor that keeps their portfolio steady. And here's one you might not expect: alternative assets. These are investments outside the usual stocks and bonds, and they can add a whole new layer of protection. Think gold, fine art, or even rare collectibles. These assets often move independently of the stock market, making them valuable when everything else is in flux. The rich have been putting money into things like gold and luxury watches for centuries. These items are not just status symbols, they're stores of value that can be sold or traded if needed. These tend to hold value or even appreciate when markets are volatile. In fact, during times of crisis, demand for these assets often goes up, pushing prices higher. But above all, the wealthy focus on diversification. They don't put all their money in one place. They spread it out to reduce risk and increase their chances of success. They're not just in one thing. They're in stocks, real estate, bonds, alternatives, you name it. This mix helps them weather any storm, because different assets react differently to market changes. That way, if one area gets hit, the others can cushion the blow. It's like having a safety net for your wealth, so you're never caught off guard. Here's the real secret. It's not about timing the market. It's about time in the market. The wealthy know that patience pays off, and that staying invested through the ups and downs is the key to long-term growth. The wealthy stay calm, look for bargains, and play the long game. They don't let short-term noise distract them from their bigger goals. So next time you see the headlines screaming recession, remember, downturns aren't just a time to survive. They're a chance to make smart moves and set yourself up for future success. For those who are ready, they're a time to thrive. With the right mindset and strategy, you can turn challenges into opportunities and grow your wealth, even in tough times. If you found this useful, hit subscribe for more insights on building wealth, no matter the markets. Stay informed, stay confident, and remember, the best investors are always learning.